Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I wanted to do a video about high yield investments, and I'm going to look at covered call ETFs and split share corporations. I've been having various discussions in various places like Facebook and TikTok, and just thought I would put all my thoughts into a video. So let's look at covered call ETFs first. So covered call ETFs use options to increase the cash flow and the yield. I've done a video previously on how to use covered calls. So covered calls means that there is a option sold for a premium, promising to sell the stock that the ETF owns if the stock price goes past a certain point. And the ETF loses the stock at that point. And so in an uptrending market, the ETF doesn't get to take advantage of the stock price appreciation. But there is the premium, which is causing the cash flow and the high yields. So, for example, let's look at QYLD. This is one that I get asked about frequently. It's a NASDAQ 100 covered call ETF. NASDAQ is mostly tech companies which tend to pay no dividends or very small, and the stocks can be quite volatile, and so the covered calls end up having a high premium. So QILD is yielding 10.73%, which is very nice, but the total annual return is 11.45% annualized over the last 5 years. So there's very little price appreciation, with most of the gains coming from the yield. So let's compare the QILD covered call to the NASDAQ 100 index, the triple Q, and you are missing out on a bunch of gains because the triple Q gained 27.72% each year over the last 5 years. That is a significant difference. The second type of company that I wanted to cover that pays a high yield is the split share corporation. It's a company that owns stocks of other companies, like an ETF, but the split share company has two types of shares: the capital gains shares and the dividend paying shares. The capital gains shares pay little or no dividends, but get the capital gains or losses, while the dividend paying shares get the high yield that we're looking at. An example of a split share corporation is Financial 15 Split Corp, or FTN. This has North American financials in it, and it's yielding 12.56%, but as you can see, has lost half its value since 2018. The average 5-year yield is 17.55%, but if we take off the 10% per year for the capital losses, we're into single digits total returns. Now let's compare this to the iShares US Financial Services ETF, IYG, uh, which is getting a 5-year annual total return of 14.54%. So significantly above the single digits total returns that the split corp is getting. Also, a bit of a warning about split share corps. As of April 2013, there were 34 split share corporations on the TSX. Back in March of 2008, there were 63 split share corporations. So in the span of about 5 years, almost half of them went away. So if you like having significant monthly cash flow, you can take the high yield route and miss out on the gains from the stock appreciation. Also remember, if you took the regular stock route and own stocks that don't pay as much dividends as you need, you can always sell a few shares if you need cash flow. But you need to decide for yourself and on your needs, on your money needs, and just on your investment outlook, which route do you want to take? Do you want certain monthly cash flows, or do you want a higher total return, but perhaps with some volatility and maybe smaller and quarterly cash flows from dividends, and having to periodically sell something? You'll have to decide that on your own. Now, to be fair, some of the split share companies are less volatile than the underlying stocks, and during the bad years, they don't seem to lose as much as the underlying shares, and yet they keep paying the yield. The covered call ETFs, on the other hand, lose as much as the underlying shares. They just don't gain as much as the underlying shares would. Also, some of these high yield payers pay as much or more than the average 10% return for most indexes. So you may be doing fine compared to the index just by getting the high yield. And some years, the dividends on regular stocks are the majority of their returns. That is, the capital gains are minimal or negative, so the high yielders will make you happy those years. So that concludes my expose on the covered call ETFs and split share corporations. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.